What is twisting? Twisting is an illegal insurance practice where an agent induces a policyholder to replace an existing policy with a new one through misrepresentation or incomplete comparison, often to generate new commission. What is twisting? Twisting is an unfair trade practice in insurance where an agent uses misrepresentation, deception, or incomplete comparisons to convince a policyholder to replace an existing policy with a new one. The practice is driven by the agent's desire to earn new sales commissions. Hashtag how twisting works. 1. Agent identifies client with existing policy. 2. Agent presents misleading comparison favoring new policy. 3. Agent omits important facts about existing policy benefits. 4. Client replaces adequate coverage with potentially inferior policy. 5. Agent earns full first-year commission on new sale. Hashtag examples of twisting misrepresentation. Reality, your old policy is worthless. Policy has substantial cash value. This new policy is much better. Benefits may be comparable or worse. You'll save money, ignoring surrender charges and new costs. Your coverage will increase. New policy may have exclusions. Hashtag twisting versus. Churning practice definition. Typical target, twisting, replace competitor's policy, external policies. Churning, replace own company's policy, internal policies. Warning signs, pressure to cancel existing policy immediately, incomplete comparisons of coverage. Focus on one benefit while ignoring others. Agent criticizing current insurer. Rush to sign without review period. Surrender charges not disclosed. Hashtag why twisting is harmful too. Exam tip. Twisting equals misrepresenting to replace coverage. Churning equals same thing but with own company's policies. Both are illegal.